Tesla's stock price is down by a considerable amount. Now, what does that mean for investors such as you or I? We are going to investigate what this company is doing right and what they're doing wrong. They were recently reported their earnings, stock price got rocked, and a large proportion of that is due to the fact that their profit margins, their operating profit margins, decreased year over year by about 8%, according to this Barron's article. Two major things are causing this problem. One being a high interest rate environment, and two, the economy being a little bit shaky and people not having enough disposable income. Buying cars is the last things on people's list, especially a fancy electric vehicle. Also, Tesla's starting to face a lot more stiffer competition. There's Ford, there's Volkswagen, there's GM, there's all these other players that are entering the market in the EV space. They're going to get their work cut out for them. They have the lead. Now, are these other companies able to close the gap? This might be the push that they need to close the gap on Tesla. Let's see what the numbers say on this business. And in order to figure out what they're doing, I'm going to go over to the StockSpec software. There's a software I like to use to analyze this business effectively and efficiently. So $213 is currently what the stock price is worth right now at the time of recording this video. And on the financial valuation score sheet, it's getting a score of 6 out of 10. Now, this software will grade the company based off the last 5 years, based off how strong their balance sheets are. 5-year price earnings ratio sitting at a whopping 391.21. So essentially, if you have been purchasing this business prior, you are essentially paying an extreme premium for these earnings, something we don't want to do. Also, the return on equity has been terrible over the last 5 years, sitting at 3.6%. Here, there's not all doom and gloom. We've seen a decrease in price earnings ratio, and our return on equity for the trailing 12 months is sitting at a whopping 26.55. So we want to see a healthy return on equity, ideally above 15%. Something to also keep in mind, their share dilution is up by 5%, indicating that they've been diluting shareholders. So essentially, your piece of the pie that you own of this business is essentially getting smaller and smaller. We want to find companies that have been buying back shares or at least keeping the share count the same. And last but not least, return on invested capital average is 8.37%. Not the worst, but we want to find companies around 10% or higher. Now, compared to the return on invested capital for the 5-year average, sitting at 8.37, the return on invested capital for trailing 12 months is 20%. That is extreme improvement over the 8.37% that we've seen. Now, hopefully going forward, they're able to keep up this high return on invested capital. Now, those are the things to keep in mind of where Tesla's kind of lacking: high price earnings ratio, share dilution, low return on equity. But they're making improvements in a bunch of those categories. Their PE is lower, return on equity is higher, return on invested capital is higher. The main red flag right now is their share dilution, sitting at 5% over the last 5 years. But what are they doing right? Well, to start off, the current ratio is sitting at 1.59. And why is that important? Ultimately, we love finding companies that have enough assets on hand to cover their liabilities, especially in the economic climate that we are in right now. Their EPS growth is a 300% increase over the last 5 years. So if you've been holding on to this company, you should be very happy because you're getting more bang for your buck based off those earnings per share. Now, also their net income is up, the free cash flow is up, and obviously their revenue is up as well. Just to give you an insight, it's up by 50%. And if I just go over to the income statement, we went from $2 billion in revenue, and look where we are now, we've exploded over the last 10 years. They are currently in a major trajectory course of increasing their revenue, something we want to see. But more importantly, going to the cash flow statement, and we'll go on an annual basis, where do we land cash flow wise? So we're going to go over to the free cash flow section here, and currently in 2022 we reported $7.55 billion of free cash flow. 2021 was 3.48, 2020 was 2.70, and then pretty much $1 billion. And then prior to that, we were in the negatives. They've been jumping like leapfrog to get their free cash flow in the positives, and they've doubled it from year to year. Now, Tesla has a lot of things going for it. I love the fact that their revenue growth has gone up as much as it has. Free cash flow is making huge improvements, and net income is up as well. 6 out of 10 isn't a terrible score considering the fact that, one, they're making improvements on a lot of the things that they've gotten a point deducted from. One being the price earnings ratio, as we're currently sitting at 55, way more favorable than 391. The return on equity is much higher, as I said, at 26 compared to 3.60. And our return on invested capital is sitting at 20% compared to 8.37. Now, ultimately, we want to find and hope that they're able to keep up this trend. And I didn't even bring up their debt to equity ratio, which is incredibly favorable, sitting at 6.93%. And ultimately, what that means, they are fueling the business through equity rather than taking on debt. Low debt is always great. The only caveat to this one metric here is that it's canceled out by the amount of share dilution. So essentially what Tesla has done over the last 5 or so years is we're going to hand out shares because people love the stock, people like buying the stock, and we'll fund our operations that way. However, in doing so and people buying the shares up, your piece of the pie has shrunk down by a considerable amount. So that gets nulled out by the share dilution. Now, if it gets nullified, it's not the worst thing in the world, but I mean, it's always good to see a debt to equity ratio very low considering the fact that high interest environments are currently at play. But ultimately, what is this company worth? In order to figure out what this company is worth, we have to go to the price analysis section. And if you're enjoying the video, folks, hit that like button and subscribe button because it means a lot to me, it means a lot to the channel, it helps out with the YouTube algorithm. The software I'm using, follow the links, description box below, 7-day free trial. And if you use the coupon code FOUNDER, you get 20% off for life because it's a brand new software. We're working to make it better for you, for the investors, to help your analysis journey be much more simplified and much more efficient. Here's what I've done. If you're new to the channel, I like to try to stay as conservative as possible to give myself the biggest margin of safety. And in order to do that, I had to put in a couple of factors into my head. Well, one being the high interest environment that we're currently in. Two, the fact that there's a lot more other competitors coming after Tesla. And three, the fact that the profit margins have been decreasing and costs are getting higher. That being said, I've done 25, 30, and 35% revenue growth over the next 10 years, really concerning ourselves with the conservative side of this evaluation. Profit margins sitting at 10% because I'm giving a haircut currently based off of the fact that the profit margin for the trailing 12 months was 12.97%. Free cash flow margin, I'm giving it a haircut, sticking between 7 and 9%. So I've done 7, 8, and 9. Price to free cash flow, something more manageable, 14, 16, and 18. Desired return, 13%, lucky number 13. And we're gonna click calculate. And what this software is gonna do is gonna add up and crunch all these numbers and print out what we should be paying for this business. Wow, was not anticipating that. I never thought I would see the day where I'd get green numbers on Tesla. Here's the thing. These two categories, I think they're somewhat high considering the fact it's a $675 billion business. If you really believe these numbers, folks, on the high end, this might be a buy for you right now, considering the fact the price is here. But one thing to definitely keep in mind, I was really hoping that this would be green, but I'm more so interested in this number here. So I think 25 is good. I just think maybe 27 should be into play and 29 should be into play. Now, is that going to change it too much? I don't know. $212, average calculation comes up to 431. So we can, let's say growth shrinks a little bit for this business. Yeah, maybe it is around $316 for this business. The only thing that's kind of turning me away is the share dilution and the other corporations that are coming up and catching up with this business. Guys, I'm completely taken back by the fact that I actually have a green number for Tesla. I've analyzed this company time and time again, and maybe I've used some really heavily conservative numbers, but never have I gotten a green number for Tesla. Now, currently the stock price is at $212. If it gets below this $200 price right here, I'm going to be very happy. I think what needs to happen, though, is a lot more research needs to be done in regards to their moat. And that's the one thing that's in the back of my head is, do they have the moat to hold off Ford and GM and other EV companies? I think they've given themselves, yes, they have the head start, but do they have enough slack to just not make sure those guys catch up. And that's the one thing that's kind of bothering me. And it's something I have to dive deep into. But if they do, and this stock price goes below $200, this might be something worth for myself to pick up. And if you're already invested in this business, now you should be very happy that the stock price has gone down, because I mean, if I was in your predicament, I would just double down and just keep adding to my position. But for me to get in, I want to make sure I'm giving myself I have the biggest moat, I have the biggest margin of safety, and I've completely reduced my downside risk. If you found this video helpful, hit the like button and subscribe button. The software I'm using, like I said, is available by following the links in the description box below. It's a phenomenal piece of software that is currently more so in development to add more features, and it costs less than your Netflix subscription. And the difference is between this and your Netflix subscription is that this will potentially make you a lot more money and not waste your time. So if you found it helpful, if you like it and you want to try it for free, 7 days, links in the description box below. I will see you in the next video. Thank you so much for watching.